You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-exciting Options Insider Radio Network, a full baker's dozen worth of programs for you guys to check out on said network, including all of the well over 100 archived episodes of Volatility Views. Where can you find all of that great content? Well, of course, the mothership, the flagship, theoptionsinsider.com, as well as iTunes, Stitcher, Aha Mobile, all of those fun purveyors of podcasts as well. And of course, if that's too much for you, just download the mobile app available for iOS, Android, even all those Kindle Fire devices out there, and you can check out all the shows there as well. No shortage of ways for you guys to check out the shows, to download them and stream them, and then afterwards, or even while you're listening, to engage, send questions, send comments, give us your feedback. We love to hear from you guys. And joining me on the old Volatility Views panel today, starting off with the man beaming in from the Option Pit World HQ, Mr. Mark Sebastian. Mark, welcome back to the program, sir.
Hey, Mark. Good to be here. Jared, we missed you last week, but we did our best to sound smart anyway.
Yes, we did. It's a difficult labor on behalf of you and I, Mark, but we managed to make it sound good. He is, of course, referring to Jared Woodard, the derivatives major domo. He has many titles over there at BGC Partners. Jared, welcome back to the show, sir.
Thanks. I'm really glad to be back with you guys, Mark. And Mark, I missed you so much.
The dueling marks here on Volatility Views. And listeners, I sound like I have a bit of a cold. It's because I do. But I'm sucking on lozenges. I'm trying not to cough on the microphone, so don't worry. I won't transmit it through the old airwaves. Meanwhile, it's time for us to keep on rolling right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is indeed the portion of the program where we break down what's going on in the world of volatility, kind of break down the week that was from a volatility perspective. And what a week it was. A lot of things really happening this week. Of course, our friends over there at the ECB really kicking some steam into the old S&P 500 and taking the vol out of the market as well, crushing everything going into the latter half of the week here, squeezing a lot of vol out of things. Speaking of vol, it's been a volatile start to the year here, looking at some data coming out of Bloomberg and Goldman as of Thursday, which is when this data was compiled. The S&P has essentially had 14 straight swings of more than 1% intraday. It was the longest stretch since it did it 18 days in a row back in June of 2012. Looking at the average moves of the day, of course, it averaged a little over 0.5% in 2014. That was one of the quieter years on record for U.S. stocks, at least for the last decade or so. We're already close to double that. We're at 0.85. Again, very small sample size, only the beginning of the year, but still, it's been a very, very volatile start to the year. Of course, 1% moves pretty much every day. Intraday moves, of course, we're talking about, including some pretty aggressive moves. One of the more volatile sessions we've seen in a long time back on January 13th. So all of this is really just making for a pretty fun, pretty interesting week. Jared, I'll give you pride of place because you didn't get a chance to join us last week. So what caught your eye in last week as well as this week's volatility trading?
I think maybe the most important thing and the most notable thing in the markets in the last couple of weeks really has been the fact that we've had all these big surprises, both economics and markets-wise, but they've come from so many unusual and so many different places, from the longer-term move in crude oil that we've been talking about for months now, to very short-term and sudden and completely unexpected things like the Swiss National Bank removing the peg, Bank of Canada acting, even Denmark, but not just currencies, but interest rates as well changing, and certainly the ECB. I mean, it's been, if you're in fixed income, currencies, or commodities, then this has been your year so far in terms of news, potentially tradable news at least, and so equity investors feel like, I think equity participants feel like we've been along for the ride in some respects. Obviously, a lot of this stuff has important likely impacts on equities, but it's been just interesting how many. It feels almost kind of like you have to be an expert on everything, I think is the way I would characterize this year so far.
Yeah, you're right. There are a lot of factors at play here in the markets going forward. This show has been running for a while, obviously, and certainly since Q4 of last year, that's when it really seemed to kick off in terms of all of these other assets really coming into focus, coming into sharp relief, much more so than I can ever really remember them in the history of this show. This is certainly the longest period we've ever talked about commodity volatility, in particular crude and, of course, the metals and now currencies. It's kind of been an ongoing commodity volatility story, which is kind of interesting because this show has always been so heavily predicated around equity and index volatility. So it's kind of interesting to see a little bit of a shift of a narrative. And you're right, you kind of have to all of a sudden shift your focus now away from not just the term structure of VIX Futures and what's going on in the implied vol and the S&P, but what's going on in crude and the metals and the rates and the currencies. It's really become a much more broad spectrum play, and indeed a broad spectrum show as a result. But we do like to talk about the equity volatility as well. It has been an interesting week from an overall VIX cash perspective. We are recording this, listeners, Friday, January 23rd, for all of you guys playing the home game. And it's been an interesting downward move from a vol perspective for the latter half of the week here. We started off pretty high, getting up over the 20 handle earlier in the week. It hit a high of about 21.37 in the old VIX cash. And then we saw it tapering off for the rest of the week, particularly fairly aggressively after the ECB announcement. And we hit a low just now, I think, in the VIX cash of about 15.83. So we'll probably trend lower as the show goes on, listeners. So stay tuned for that. We also saw some interesting action out there in VIX Futures land. Of course, we had VIX settlement this week. The Jan Futures going out at 20.97. Seemed decent at the time. I think in retrospect now it seems quite high, but that's what happens when so much happens during the week. And we got some of that backwardation seems to be easing out of the market now. We talked a lot about that last week and how sharp that was. Everyone, of course, anticipating what was going on with the ECB, and now we seem to be heading back into our typical, more contango-esque pattern out there in the futures. Mr. Sebastian, it's been a fun week to watch all things VIX. What really caught your eye in the VIX cash? What's going on in the broad market, as well as, of course, what we saw with settlement and all that fun stuff?
That I'm less inclined to think that print was particularly fair. It was a 2-point print up, but you could see it coming.
I was being charitable.
Yeah, typically when we've got one of these big events, that really does open the door to having a funky print. If you're one of the people that carried a lot of people had the 2021 call spread on going into the print, and it settled 2097. So that was really interesting to see how that thing printed out. So they ticked it up a full $2. Which was pretty impressive in my opinion. Now, an interesting trade that actually just went up today, Mark. You remember last month, or was it maybe 2 months ago, where we saw that big put buyer? He was buying hundreds of thousands of like the 12 puts.
Yeah, he's back in Feb now.
12.5 puts. I think it's the same guy back again. Guy bought 200,000 of the 14.5 puts today, paying 17.5 in Feb. Now, one of the things we kind of speculated was that guy was using VIX as a short, as a hedge against an S&P 500 futures short. So if that's the case, he's back in and probably looking to get short, which actually makes sense. If you look at the way things continue to cycle in the S&P 500, all right, we are back to where we were. We basically just touched the most recent high today or yesterday. So if you look at a chart of the S&P, one second as I pull up a chart of the S&P. All right, so like earlier in the month, we saw the kind of the peak print at 2064. All right, the low vol for that kind of time period, right around there, was about they're giving that IV this is out of a live vol. This is not the VIX. So but their version of the VIX. So their version of the VIX has at 1437. You know, we're in about the same area. So we're at a kind of an important juncture in terms of the S&P. You know, are we going to see vol collapse a little more, or is is vol going to kind of break out from here? You know, I've been really wary of kind of volatility cycling higher, and I'll be interested to see if we have something like that coming. Don't forget, we have the Greek elections this weekend, and I think we're sitting on the sides a little too much on that one. That is one that could, in particular, have a very negative effect on the euro, which then might cause some real problems for the stock market here. So I do think that is still in the cards and maybe being a bit overlooked. So that's kind of my thought process.
People certainly don't seem reticent to crush some vol going into the weekend here.
I think they're overdoing it.
This almost has kind of all the hallmarks of a typical earnings event. You see the build up going into the ECB. We saw that in the VIX Futures and the implied everywhere else. And then it just come out like an explosion right after that announcement, pretty much. Of course, the 1.5% move or so in the S&P didn't hurt that either. So the combination of those two, you're right, really just kind of squeezed every last bit of juice out of this market. And it'll be interesting to see if some people end up regretting that, perhaps, latter part of this weekend with some perhaps quite literal weekend risk on the table going into the weekend. Since we're talking about VIX options here, let's dive into that a little bit. Of course, we had expiration and then settlement this week, and so as it typically happens, the OI is kind of falls off a cliff after that, but this is pretty aggressive even for that. VIX options have been averaging close to 6 million contracts open interest, about 5.7 to 5.9 or so in that range. Typical open interest, and right now it's 3.2 million, so it's off a cliff. That might be, I'll have to dig it up myself to see if that might be, at least for the last few years, a record low. So not a lot of love flocking into the old VIX options. And Mark, you were talking earlier about those Feb put buyers. They are indeed back in force. When I was compiling the hot strikes where people have been playing in this week, it was a pretty anemic list. I think our friend out there in VIXland had done, when I last checked about an hour ago or so, about 230,000 of those VIX or those Feb. I believe there were 12 puts, and so that number alone is pretty much 2x the number one spot here on this chart. Aside from that massive print of 230,000 contracts, which will certainly be the number one open interest position coming in tomorrow, our number one now is a pretty anemic 121,000 contracts here on the Feb 30s. The Feb 30 calls, actually, and it pretty much just falls off a cliff from there. 120,000 for the Feb 20s, and then we get some more put love. We get the Feb 15s and the number 3 about 110,000. Then the Feb 25s at 107,000. Feb 18, 14, and 16 puts with 91, 86, and 78,000 respectively. And the Feb March 25, calls are tied for 78,000. And then bring up the tail end of the list. A very, very anemic list. Most of these wouldn't even be anywhere near the top 10 on a given month. 70,000 of the Feb 18s and 66,000 of the Feb 17 puts, again, for a total of only 3.26 million contracts open, about 2 million on the calls, and about 1.2 million on the puts. That's also the closest we've seen calls to puts out there in VIX in quite a long time. So Be interesting to see our friend today, of course, notwithstanding. Be interesting to see if what we see in the coming weeks is people flocking back into VIX again, or if they're going to kind of maybe play wait and see now that a lot of the big events, aside from the Greek election, have kind of run their course in the marketplace. So we're going to see these anemic levels of open interest and relatively paltry, not too terrible, but relatively paltry levels of volume out there as well. Speaking of anemic and crappy and just generally weak and mysterious volume, it's our old friend VXST, which yet again, even another rockin' sock'em week, continues to really just mystify people across the board, doing pretty much no paper. Yet again, let's see, today as we're talking, as of today, the 23rd, it has done 0 contracts, did a whopping 14 yesterday, 5 the day before. It's just anemic. In fact, we had a great write-up on the website, theoptionsinsider.com, I believe was called The Mystery of Short-Term Volatility. We kind of broke that down in a little bit on the site, so I encourage you guys to surf over and check it out, talking about some things we talked about on the show in the past, how this name has set records on days when its mother products, the VIX and SPX, don't really seem to be doing a heck of a lot. And then on days when those ones are setting records, it's doing literally 0 contracts. It's just a head scratcher. In fact, I had a chance a week or so ago to chat with the folks at the SIBO about that. I kind of asked them that specifically. They were talking about a bunch of other things, and I kept bringing it back to VXST. I kept saying, what is going on with this product? Are you guys planning any fixes? What's the deal? And they kind of admitted pretty much, and you can see all this in that article as well, that it's been a bit of a surprise for them too. They kind of thought, kind of like with some of the other products they've launched, it seemed like two great tastes that taste great together. SPX weeklies are lighting it up. They're about 32% of overall SPX volume right now. So it seems like a short duration VIX product would be a no-brainer. And yet none of those people, SPX weeklies continue to grow, and literally no people on some days are touching the VXST, which they kind of admitted it seems to show that there's a different customer interested in the VXST products, a different use case entirely, and they're looking to resolve that. They also admitted they've added some market makers. That was one of the problems with VXST. We've heard a lot. The markets were too fragmented, too illiquid to really get anything off out there. So hopefully some of these new market makers will also check it out. So I encourage you to surf on over to the website and check that out for yourself if you haven't, and kind of take a deep dive into the ongoing mystery that is VXST. Jared, I know you talked about this before on the show, but do you continue to be as mystified as we are on this the ongoing saga that is this product, and the fact that yet again today, literally 0 people have adopted it in today's activity?
Yeah, I mean, at some point you have to ask about whether the revealed preferences in the market, as evidenced by volume, when those are just kind of incontrovertible evidence. You'd have to make a really tight argument that, I there's some room, I think, for the role of, improved liquidity and liquidity providers making a difference. But it's also the case that, there's just no natural buyers, natural traders in some contracts. And, I'm not ready to shut the door necessarily on this. But look, one thing I would mention, that we've probably talked about this before, but I think that the demand for volatility exposure in the very short term is probably saturated with the existing products, and that as the overall market environment changes, I think a lot of people are looking out a little bit further on the curve. Honestly, the returns from short vol strategies at the front end have deteriorated pretty rapidly over the last year on a risk adjusted basis. So if you look at the rolling Sharpe ratio of short vol strategies, that have otherwise identical rules, but just differ only by maturity, the medium-term focused strategies have performed much better per unit of risk than stuff focused at the front of the curve. And by front of the curve, I mean like 1 month, let's say, maturity. So if you try to market a product that's got a 9-day window, you're already by definition just going to be working with fairly active traders and active managers. But given the changes in market composition involved, and how many kind of gaps and the amount of jump risk and sort of unexpected things from the macro environment that have been going on over the last year, I think it's just a tough time for a product that has such a narrow narrow focus. So anyway, that's my take on VXST. It doesn't mean that other novel volatility products might not be successful. It's just that even though the weekly options are really successful, it may just be that when you combine the very short maturity with the trickier calculations involved in VIX products that is just a little bit too complex for the demand that exists right now.
Yeah, I think you and Sinclair said it best on the show a couple of weeks ago. We said, did anyone really ask for this? Did we really need this? And I think so far, at least, the market's answer is a resounding no. Of course, a lot could be changed in the future. Maybe the market makers will change something out there. Maybe this added liquidity will drive some more interest in it. It just is a very, very odd story, to say the least. I should correct myself from earlier. I think I said the Feb 12 puts. I meant to say the Feb 14 puts going up out there in VIX to the tune of 232,000 contracts as of our current recording time. That may even increase as we're seeing more contracts going up out there. So that could be our old friend coming back to play in some very, very substantial size. And interesting, again, we don't talk a lot about people piling in to the put side of VIX very often. So it's interesting. That in and of itself makes it an odd trade, let alone the outlandish size of the trade. So very, very interesting in and of itself. Well, moving on from the domestic shores to the overseas side of the fence, it's kind of hard to really separate the quote-unquote international vol with what's been going on out there in the currency landscape these days, Jared. So maybe we'll kind of combine those together, because it has been just I think Andrew on the show a couple weeks ago called it the black swan of black swans out there in the certainly for the Swiss franc, and that's kind of hard to argue with that summation. It's been just a crazy town, I think, to put it more colloquially, out there in currency lands of late. There's a great chart. I pulled it over there at Daily FX, which is actually part of that FXCM.com, which got hurt so badly as a result of that Swiss franc deal. They had a great chart of, and we'll put it in the show notes, listeners, so you can check it out, and we'll link to it as well, of the largest single-day currency swings since the inception of the euro, so going back to 1999, and they have it for pretty much every big currency pair you can think of: Aussie, US dollar, euro, Swiss franc, etc. And not surprisingly, the euro Swiss franc had the lowest, biggest downswing ever in its history back on the 14th of January, 18.9% to the downside, and the dollar Swiss franc had a similar move, not quite as bad, but almost 17.8% downward move on January 14th as well. Both of those being dramatic outliers on this chart. Most other things, you're talking euro, US dollar, the biggest drawdown that's had is about 2.7%. So most of these other currencies move in relatively static ranges. I think the other biggest drawdown aside from these is in the Aussie US dollar spread, which dropped about 7.4% back in 2008. You might expect that then. So other than that, the Swiss franc movements are a complete outlier on this chart, and really showing just how much has been cooking out there in FX land as well. Jared, I'd imagine a lot of your traditional equity clients these days are calling up saying, "What the hell's going on in currencies?" I bet you're getting that call a lot these days.
Yeah, I mean, that's been a big topic. I think there's an interesting point for apart from the economic effects of all this, for listeners here, a kind of a good lesson, or a good reminder anyway, that recency bias and short look back windows, and just kind of all of the different dangers that are always present in the background when you employ any kind of carry trade or short vol trade, which is kind of the same thing, that things that have been stable or have looked a certain way in recent history might not be. And I think that the Swiss bank episode in particular, I think there's an interesting wrinkle to this, which is the difference between just kind of general broad agnosticism about what's happening or what might happen in the future versus really informed and really careful, studied awareness of what's possible. And you could contrast this with some of everyone's been correctly pointing out that no one expected the Swiss bank to remove the peg right now or with no forewarning. But there were some strategists and economists who were looking for a possible change in 2016. And they were citing, I think, some of the same concerns that might have been motivation. One of the things that came out was that the Swiss bank is, it's privately owned, and so there was pressure from some of the shareholders actually to make a change, because it was both the dividends they were getting were apparently inadequate, and they were worried about balance sheet losses ahead of the ECB policy change. So, and I think that's a very different kind of a beast than the, as I say, sort of agnostic and just cynical, throw your hands up and admit defeat, sort of black swan and sort of Austrian view of the world, where everything is just unknowable and it's you can never try to predict, so don't even try. I think that kind of a view of the world just leads to sitting on your hands forever and maybe staying in cash forever. I don't know, but in this case, I think the issue was not so much people making incorrect predictions as much as being over leveraged and not paying attention to slightly longer term history and some of the policy details, really. And so in that sense, I think there's a lesson for equity investors, because the economic environment is changing for stockholders. Wages are probably going up in a meaningful way in the second half of this year. Obviously, rate policy is likely to change. And all of that has historical analogs. It's just that you have to go back further, and you have to kind of adjust for things that have changed between now and those earlier periods. But, that's a far cry from saying that everything is unknowable or that these are things no one could ever foresee. I think it just takes more work is the bottom line. And that, once you're doing that work, as long as you're not, sort of over-levered or assuming that the future will be just like the recent present or the recent past, then you can escape, I think, a lot of these dangers.
In case you're playing the home game, listeners, it was 26 minutes in before Jared's first philosophical reference of the show. So take a drink at your earliest convenience. Mark, I'm sure you guys normally don't focus on currency vol, but I think a lot of us have had our heads turned that way of late. So what's been the big chat over there in the pitch chat amongst your clients and mentees? What are they trying to trade as a result of this? And what's been their general reaction to just this crazy town movement we've seen out there in currency vol over the past couple of weeks?
Yeah, well, as we often see, lows can turn into highs really quickly. And, just this time last year, if you looked at all the volatilities of the currencies, they were all at essentially all-time low. And now here we are, and many of them are touching multi-year highs. And so, I think a lot of people were because of what's going on over there with the euro, I think a lot of people have started really paying attention to the currencies. I know a good group of guys that are trading the futures options on the currencies, although, those markets are kind of wide. I heard through the grapevine the CME did not have a big clearing position on those futures options. Otherwise, so no statement coming from them apparently on, losing a ton of money in clearing. But, I think that was the interesting thing. We were all a little surprised, actually, that there weren't more funds forced to liquidate, which shows you that while this was really a surprise outlier trade, it was really a small group of people that really got caught with that swap trade on. And but it goes to also say that, the crowded trade is usually the bad trade. And that Euro Franc trade was super, super crowded among the retail environment. As the old, the old taxi driver or shoe shine boy had the short franc long euro trade on.
Yeah, I heard every time going over here, you'd hear nothing but the Euro Franc trade all the time.
You'd be shocked. I've gotten in Chicago. I've gotten in at least 5 cabs where they ask me what I do, and then they go off on the fact that they're currency traders for a 20-minute diatribe. Jared, you're unshocked, correct?
In defense of the retail trader, there's been a lot of fairly respected, well-respected, and otherwise successful, hedge funds and other kind of institutional managers who've also taken big hits on this. A lot of companies are citing increased currency risk, and so I think this is something that, when there's a really sweet carry trade to be done, or just a cheap funding currency or perceived haven of stability, in a kind of a world, excluding the U.S., a world that's desperate for demand and desperate for stability and safety still, people were tempted to this. And I think it wasn't just, it certainly was plenty of individual investors. But, look at FXCM and some of the other retail brokers that were so confident in their own, ability to leverage relationships with customers that they kind of blew up. I think this was hubris was pretty widely distributed, I would say.
Yeah, FXCM still taking on the chin, trading $2.34 today, down another almost 25% again today. We saw people flocking into calls in their last couple of sessions, maybe trying to play a little bit of a bounce, but those have all not worked out in their favor as the downward pressure continues out there for FXCM. Of course, one of the brokers taking one of the largest hits as a result of this big Swiss Franc debacle. They had to take about a $300 million infusion, I believe, to stay afloat. Of course, looking at some interesting charts over the past few weeks, too, how much capital was flowing in and out of that region just to keep that peg stable. And it kind of makes you wonder maybe why they didn't do something like this, maybe not as drastic, but a little bit earlier, because there was a lot of capital being expended to really maintain that peg. And you can kind of see maybe the tea leaves are starting to line up to that, even if it didn't, maybe not to something that extreme, but something was probably brewing in those waters in the coming months. Speaking of an endless downside, of course, that's our segue into crude. Crude continues to be a bit choppy. There have been a few moments this past week when it seemed like it wanted to flirt with a little bit of a rally, and every time something seemed to conspire to chop the legs out from under it. As we're recording today, WTI hovering on the 46 handle, and looks like crude around on the 49 handle, so both of them south of 50 yet again, which is pretty interesting stuff. Of course, you saw some numbers coming out this week of domestic crude supplies increasing by about 5.7 million barrels, which is getting crazy levels. That, of course, weighing heavily on crude. We saw Iraq kind of almost counterintuitively talking about how they're going to increase production to kind of offset the declining revenues. Of course, you think about it, listeners, you're not selling enough. Make it up in volume. Your price is dropping. Just make it up in volume. So they're, if anything, exacerbating the situation out there in Iraq by cranking up the spigot. And if that wasn't enough to really make things kind of confusing and odd out there, we saw this morning the death of the Saudi king over there, who I believe was 90 something, and talk about a very aged royalty over there. The crown prince, who's now the king, is 79, and the next in line behind him, the new crown prince, is 69. So a little bit of an aged populace over there. A lot of people wondering if the death of the king was going to reverse that oil policy, but so far it seems like they're standing firm on their policy. In fact, the king's nephew has said multiple times and reiterated it again this morning that the world will never again see $100 a barrel oil. That's simply not tenable, which is, of course, the exact opposite position that they had back in June or so of last year when they said that was about the perfect price for oil. So a lot of interesting, conflicting things hovering around out there to cause a lot of head scratching, a lot of vol out there. OVX, of course, the volatility of USO, that popular oil ETF, also floating around some pretty high levels out there these days. So things are interesting. Let's just put it that way. Interesting out there in crude land. Maybe, Jared, we'll start with you. Anything in particular really catch your eye out there in crude vol over the past week?
I mean, if anything, it was the fact that as the price started to stabilize and kind of turn sideways, implied vol didn't seem to respond all that quickly. Stayed kind of high, which, given recent action, is kind of fine. But there's some nascent signs of demand picking up, and I think that really the fundamental story is the big disappointment in retail sales was, caused, I think, by a lot of folks, me included, looking for bigger demand numbers as consumers save all this money. It looks like there's some good evidence so far that in the fourth quarter they may have just saved, the kind of money they saved on gasoline and other energy costs might have just gone straight to savings rather than into spending for the fourth quarter. And given the long-term consumer trends in the U.S., I think that probably points to increased demand, if not this quarter, then the next for sure. I mean, because you just don't have Americans saving cash like that as a kind of a behavioral thing, or in terms of the trade balance, typically. So as a result of that, it may be that demand for gas and for energy might remain kind of flat. But yeah, I mean, in the short term, oil prices stabilizing, I think means that we should see some further downside for implied vols. And I think that commitments to traders report from the CFTC later today on Friday is going to be really important to watch, to see how positioning has changed over the past week compared to what had been a pretty notable change in trends versus where we were, say, a month ago. So I think lots of stuff to look at, but that is still a positioning kind of a driven trade right now rather than driven by fundamentals.
Yeah, that CFTC report will certainly be interesting to watch. We have been noting, of course, on this show and others, that ever since it kind of slid south of the 70 handle or so, a lot of those traders have been flipping to the long side. Long positions have been increasing. All those traders have been getting burned time and again, really. It hasn't really been a good trade of yet. We'll see if this latest report continues that trend of people starting to flock into the longs, or they're maybe starting to take the heat they've been feeling and just kind of pare those back a little bit. We'll see. It'd be interesting to watch. Either way, it has been kind of odd times out there. Speaking of odd times, Mark, I know you guys like to watch and play around, mostly in the USO side of the fence. So, what's been catching your eye out there with USO, and as well as what's going on out there in the options?
I continue to think that as we look at oil, it's kind of found a floor. Nothing special in the options. I don't really like USO is a okay product, but they did make it a lot better than it used to be. But WTI is the better one to look at. OIV had been kind of sinking, which is the VIX of the WTI, and it's right back up to 58. It's made the last couple of days it's rallied about 8 handles. So I'm less certain that we're at the floor than I was last week. Let's just put it that way.
Yeah, OIV and OVX both seeming to get a little bit of love of late, a little bit of a pop. So that could indeed be signaling a new canary lurking in the coal mine. Everyone was thinking, oh, well, oil's done. It's found its bottom. Perhaps we've all spoken too soon. I think everyone has pretty much pronounced that at one time or another over the past 3 or 4 months. And all of us have been proven wrong time and again. So perhaps if the Saudis aren't yet ready to declare a floor, maybe we should all be reticent to do so as well. All right, well, a lot of stuff cooking in the commodity land, but we also want to make sure you guys get some time here on the old program. So without further ado, let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. As the man said, no shortage of ways for you guys to get in touch with us here on the old program. We love to hear from you. We love to hear your questions, your comments, your feedback. So let's kick things off here with a question from Marcus N. He writes, you discussed the retracement from backwardation to contango in VIX Futures on the last episode. If I thought the retracement would be rapid and I wanted to play that retracement, would the near-term futures or options be my best bet? Jared, let me give you some color because you weren't on the program last week. We had a great listener question talking about the evolution in VIX Futures and how quickly it often evolves from that kind of steep backwardation moment like we were seeing in the recent weeks into more of the traditional type of contango period. And we talked a lot about how some of the more kind of quick aberrant moves, where it kind of just pops in the near term, it kind of comes off relatively sharply versus the more kind of structural type changes that we see in that term structure and how quickly those tend to come off, which is a little bit obviously slower process. And we were kind of going back and forth discussing some interesting topics about when we've seen those structural changes happen quickly, which isn't that often. I think 2011 was the only time we can really think of in recent history that happened. But so an interesting question. Our friend here now writing in with kind of a follow-up to that question. And since you didn't get a chance to play last week, Jared, I'll let you go first. If you have a client, a mentee, someone who's coming to you saying, hey, I want to play a flip in the futures from like backwardation to contango, and I want to use the options or the futures, which way would you recommend for him?
That's a good question. So we'll make sure I understand. So the question is, if you want to play change in the VIX term structure, what's the best product? That's the
I'm assuming he's expecting on a very sharp, aggressive switch in the near term of the term structure. Would you prefer the options or the futures in that scenario?
I mean, futures by definition. I think if that's your only input,
kind of seems like it, doesn't it?
Yeah, I mean, motivating a position, you'd have to have an additional kind of view. I mean, we know that that the options are going to respond in a certain way to changes in the curve. And because we're talking about VIX here, but I like to point out in these situations, all the same analysis applies to any other product, with listed options. There's a term structure for SPY and SPX and for every stock with listed options. So just because everyone loves VIX, we could have the same discussion about, just about any other product as well. So if you think that some stock is the options are going to backwardate, let's say, or whatever it is. If you don't know where the option levels are, In this case, let's say if you don't have a view on whether VIX options are currently expensive or cheap, without that kind of additional information, I think you stick with futures and you just kind of play it straight up. You can do spreads in the futures to reduce your cost basis or get more bang for your buck, or you could just kind of buy the leg that you think is, buy a near-term leg in the direction of the expected move. One of the benefits of a future spread is that if you're wrong about changes in the curve, but the overall level of all moves in a favorable way, you can still sometimes win, or not get hurt as badly as if you had just been long or short outright. And that same thing happens in interest rates. Quite often, people are trading expected changes in the yield curve. So it's a good question, but yeah, I think the main idea, my main thought is just that if you don't have any view or other input from options markets, and you're just trading a curve outright, then use the simpler of the product suites.
Mark, same question to you. Not a lot of specificity here from our friend Marcus, but he's writing in about our discussion from last week. What do you have to say for our friend here, Marcus N?
Well, a couple things you have to think about is, if you're looking at like the ETNs, for instance, at different points in time, they're going to have different exposure to the curve. Then, the most direct way to play term structure is, straight up in the VIX futures. If you want to do it in a more protected way, then, doing it in the VIX itself is the right way to play. Now, if you really want to, if you're playing a real change in backwardation, something like UVXY as a real change in backwardation or contango, depending on where they are on the path, how much is it a split between? So like, let's take right now, right? We're filming this on a Friday. VIX expiration was this Wednesday. So VXX and UVXY are almost exclusively February futures. There's something like 94% February future. In a few days, in about 10 days, they're going to be about half and half. So you can really get, you really do increase your exposure to changes in term structure as time progresses. So that's just something to think about when you're looking at these products. That would be kind of my thought process. Is the simplest way is in VIX and VIX options. Using UVXY and VXX or XIV is more nuanced depending on where they are in the cycle.
I like it. A little bit more nuanced play out there. So there you go, Marcus N. Given your lack of specificity in your question, it seems like the most straightforward answer. It is indeed. If you expect the futures to move, go with the futures. But you can go the Mark Sebastian more ETP route if you're comfortable with those and you're familiar with the different holdings and ratios out there. A couple of different ways to play that. Good question. We like to see you guys are listening and writing in. That's always great stuff with the immediate feedback. All right, moving on to a question from Avril. I'm not sure if I'm pronouncing that correctly. Forgive me if I'm not. They write, but more of a thought question here. They write, risk premium. What is it? I've seen it defined many ways. Is it a product's 30-day implied versus 30-day realized, a 10-day versus 10-day? If using 30-day realized, that's a lagging indicator, do you then have to extrapolate that forward using an algorithm and then compare that to 30-day implied to get a more accurate number? What about comparing something like front month or 30-day implied SPX volatility versus VIX cash or a VIX future? Is that the best surrogate for the market's risk premium, or has VIX cash become such a polluted number that it's better to stick with straight SPX implied volatility? Well, that's quite a question there, Avril. A lot of different moving parts, a lot of different components to it. At the end of the day, kind of asking what really is the definition of risk premium is kind of a good question because it has been kind of bandied about a lot. I've seen it used, and sometimes correctly, sometimes incorrectly, in almost a lot of the different ways that you actually lay out here. I've seen people define a lot of those different things you talk about here as risk premium. So there are a lot of fun ways I think we could carve up this question. Jared, this sounds like this has you written all over it. So what do you have to say to our friend here, Mr. or Mrs. Avril, who wants to sink her teeth into some risk premium?
No, I like it, yeah. What is a risk premium? It's we could take the Socratic method here and everyone give an answer and then try to pick apart each answer and where it's wrong, and eventually we'd come away with the solution to a just society or something. But I think that Avril has a good intuition here, which is kind of de facto pointing out that there are all kinds of different risk premiums in the market because there are all kinds of different risks in the market. Typically in the broader literature, risk premium refers to the spread of if you think about an equity risk premium, it's the expected return on stocks versus what you could get in a risk-free rate from a sovereign debt instrument or something like that. And in options and volatility, typically, conceptually, a volatility risk premium, say, is the difference between the realized volatility that will occur in the future in an asset and the volatility implied by an options price. Now, I think she mentions this, like we don't know what the future realized vol is going to be, and so that makes it hard to know in advance, what the premium will eventually turn out to be. Sometimes people look at recent realized as a decent proxy for future realized. Sometimes people use volatility forecasting models to try to arrive at a number, and some of those actually work pretty well. I had in our outlook for this year, I drew on 2 models like that to look at expectations for the year ahead. But I think that the best answer is ultimately that there are as many risk premiums in the market as there are priced risks. I mean, there's volatility, there's the risk of standard deviation being higher or lower than you expect. There's a risk of correlation being higher or lower than you expect. There's a risk of an asset not moving in a continuous way, but making big jumps that are unhedgeable. I mean, that's a really important part of that risk. And then in the academic literature, there's actually quite a lot of effort that's gone into trying to decompose the, what goes into an options price, thinking in terms of different risk factors. And so a lot of the ones I just mentioned have been discussed in the literature: jumps, correlation, vol of vol. This is all, it's all kind of speculative in the sense that we're just trying to grasp at what makes people price options the way that they do. But it's definitely worth thinking about for your trading. What kinds of risk factors am I trying to hedge against or protect against versus, capture or take a position on? A lot of times investors will trade an asset without thinking through any of that, either at the level of equities and fixed income or even within the option space. And a lot of the products that have been launched in recent years, even the ones that have failed or have had modest success, have actually been attempts to capture or make specific some of those risk premiums. In that sense, I think they're really useful. But again, it does require some a little bit of thinking and planning in advance to know where on the curve in terms of time frame or what different kinds of factors you're trying to trade. Once you know that, then you can look for the most suitable estimates or indicators of what the premium would be for a given factor.
Mark, what do you have to say to our friend here, Mr. or maybe Mrs. Averill?
Yeah, I mean, the way we look at things historically and the way, so one of the things you'll hear Don Schlesinger say, volatility is typically overpriced by 2 to 4% all the time. And well, it's not exactly true, but what we really do is we can go back and look at, okay, what was the VIX on December 1st, right? And then from December 1st to January 1st, over that period, what was market realized volatility? And then we basically look at the spread, and that's the volatility risk premium that was priced in at the time. And to Jared's point, yeah, we don't know what the actual volatility risk premium is, but when we talk about historically how expensive volatility is or how expensive options are, that's really where that number comes from, is we look at what it was priced at the time and then what happened after. Now, best ways of estimating it, I think that, you can look at, recent realized volatility, things like that. But, that's not a simple way of looking. That's just not simple. The historical movement has nothing really to do with what the future movement is. Now, in the extreme near term, like when you see something really whipping around or really sitting still and the options have a huge premium in it, well, then maybe you can say they're pricing something in. Like when we saw the VIX get up into the 20s ahead of this ECB meeting, one thing would say was there is a big risk premium priced into the market. But we don't know what that is until after the fact. So that is what volatility risk premium is from my perspective.
Great question, Miss Averill there. Good stuff. Has the VIX cash become such a polluted number? That you don't see as many people using that, but I see some people bandying about comparing things like SPX 30-day implied versus, let's say, the VIX cash, just kind of show you what the difference is in there. So it's kind of illuminative in that sense, but that's not one of the ones we see bandied about that often. But it is used out there. But I think what you're talking about, when like Jared and Mark said, when you're talking about straightforward, particularly from an options perspective, risk premium, it's that implied versus the realized. So great question. We could probably spend a whole show on that one topic. But unfortunately, we have to keep rolling. It's time to move on into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball. This is indeed the portion of the program where we speculate wildly into the future, see what the vol gods hold in store. As we mentioned, we're recording this on a Friday. The market is crushing a lot of volatility, and as we discussed at the top of the show, that may indeed be a bit premature with some interesting stuff on the horizon coming down this weekend. So, Mark, we'll toss over to you first. What's your wild prognostication for the Crystal Ball here?
You know, I've got a couple of clients that live in Greece, and there are a lot of people over there really worried about this election this weekend and that the communists might win. So that is really their big fear. And so, you know, I think if things go haywire, there's a real chance that we could see something kind of ugly on Friday. And, you know, I don't think we're going to see the VIX get back to 14 on this cycle. I think we might stop at around, you know, we might be seeing the low right today, at least until maybe next Friday, or, you know, until we get, certainly if things go ugly on Monday, it could be a continued little rough ride here.
So 16 as we are right here in the VIX cash. That far, no further.
Yeah, well, and the other thing I'll say, and this is my big prognostication, the Fed, and I've said this multiple times, there is a greater chance of the Chicago Cubs winning the World Series in 2015 than the Fed raising rates. It's already been done for them by the ECB. They don't need to raise rates. And in fact, rates are going to go lower. I think we're going to break the all-time low yield on the 10-year note in the next 3 to 6 months.
It does seem like many of their traditional weapons have been kind of taken out of their arsenal already. But yeah, it's interesting to watch what's going on with the Fed next week. I'm not sure if the odds are that long, but they are pretty long indeed. Jared, what's your take? Point, counterpoint. Do you agree with Mark, or do you think he's on the ignorant slut side of the spectrum?
Was that Fed prediction?
Mark, you ignorant slut.
Is that Fed prediction? How long does that go for?
My prediction?
Yeah, for no rate hikes.
I think that the first real shot at a rate hike is, I would say, Q2 2016.
Oh, okay. I definitely take the other side of that one. Yeah, no, that's good to know. Yeah, I'm looking in like the summer, maybe early fall. My view this kind of end of the year was.
There we go. We got a market. What are we wagering? Pink slips?
All right.
What do we got?
Jared, here's what I'll say. How do they raise rates when the 10-year is going to go to 1.25?
Well, I don't think the nominal 10 years is really all that meaningful for what. That's not what the Fed cares about. That's not what's going to get them to raise rates. What will make them raise rates, in my view, is continued decline in unemployment, but more importantly, emerging signs of wage pressure, which we got the third quarter employment cost index was a major move higher, and we get the fourth quarter employment cost index at the end of this month. I think that's going to be a really important number. You're seeing emerging signs of this in really wage-sensitive industries already, hospitality, construction, so places like that have already seen worker shortages and wage hikes, de facto. And I think that there's, best paper on this that I think anyone could look at, and actually Yellen referenced this at Jackson Hole last summer, and a lot of other Fed governors have talked about. I've talked about this in research. Was a paper from Mary Daly at the San Francisco Fed about pent-up wage deflation, and it's useful, and I highlight it here, even though this isn't an economics sort of podcast, because it explains how you can have persistently low wages in the face of falling unemployment, and how that can make sense, and how we can make sense of that fact without having to turn to like really radical views about how there's lots of secret, deflation just around the corner and everything's actually far worse than it looks, or anything like skeptical like that. But really, if you have pent-up wage deflation from the, because of the depth of the cycle and the fact that employers tend to fire or keep on employees rather than let wages fall, that can, what you get from that, and what I think is really important to look for the second half of this year, is the possibility that wages start to go up very, very quickly once you hit that threshold. And I think that if that happens, that's really something that Yellen says she's concerned to watch for. I think if we get emerging signs of that, the Fed might actually be willing to act in a small way, like one small increase, and maybe not every meeting after that, but something to show that they're aware of this. They're not going to let it spiral quickly, which is what the real risk is. Mm-hmm. And the fact that the rest of the world's having the troubles that it's having would have been important, I think, 5 or 10 years ago. But the U.S. economy has become considerably more insulated since then. Consumption here and the earnings of our companies here are far more domestic than they used to be for our purposes of this discussion. And I think that all of that points to a Fed that it could move in the summer, if not then in the fall. That's my view anyway.
I like it. This week on the Fedcast. So what are you guys wagering?
Let me quickly throw something back at you on that. Where has been the bulk of the wage growth in the United States over the last couple of years?
Across the board. I think that
where you might see the wage inflation, it was in primarily energy, right? And, I think this move in oil could put a real damper on some of the wage inflation growth. And, one of the areas where there was a lot of demand was trucking. And that's because a lot of the low, guys who would be truckers were going to work in oil. And so I do think, I see your point. If there's wage inflation, I think that they will raise rates early. I just think that conditions have changed where maybe we won't see that.
Yeah, I could see the effects of the oil decline, not just on that wage issue, but on this kind of time gap between price declines and when consumers start to spend that surplus, which we just already talked about earlier today. I think that time lag and some of the noise from that might actually push them out, a meeting or two. But the biggest growth in wages more recently, if you look at the monthly indexes, have been in, as I say, some of the more sensitive and admittedly noisier industries and sectors, but things like hospitality, and tourism, and some retail areas, and construction as well. And that construction has been a big one for some time. And
that would be great if construction came back. That's
been where there's been some of the tightest shortages. The examples anecdotally that I keep reading or hearing about are folks who want to hire day laborers, and they'll go to a place to make those, hire those guys. And there's actually bidding wars breaking out for day laborers for construction sites. So if you see that continuing, which it has been, I think that, basically the demographics, the longer term trends here, I think are kind of extremely difficult to argue with. And so it's really more a question of timing than anything else. It's hard for me to imagine the Fed staying on. So
you think by September, for sure?
Yeah, I think by September we get.
All right, so we'll come up with. All right, so here's a challenge to the audience. Come up with a bet for me and Jared. I'll take 2016 and over. He'll take 2015 and under. And the loser has to do with whatever we find the most interesting bet. What do you think about that, Jared?
I'm game for that. I think the bare minimum, somebody buying steak either in New York or Chicago.
Yeah, I think so. I think however it works out, someone's buying steak in Chicago. I think is a good
or an
ending
RMC
to that.
or next year's RMC.
Yeah.
So I think that for sure. So listeners, the challenge is to you.
I like it. All things end with somehow buying steak in Chicago. I think that's a good wager for all and sundry. All right, it's a good. That's the end of this week in Fedcast. Unfortunately, we can keep going on that topic for a while, but unfortunately, we have to wrap up. But before we go, as always, let me check right back in with our cohorts here on the old Vol Views panel. See what they have cooking. Mark, we'll start with you. What's cooking in the land of the pit?
I've been working with Russell on another paper, this time on the put right, and then we're probably going to do another wheel research paper coming out. So keep your eyes peeled for that.
That'd be Russell Rhodes, not Russell Investments, listeners, just to clarify.
Russell Rhodes, the fine gentleman of the CBOE and my good friend and just all-around great guy. And on top of that, that's really the big news right now. Follow me on Twitter and read our blog.
And Mr. Jared, aside from the oft-promised straddle study, what is coming down the pike over there at BGC Partners?
That was your promise, by the way, on my behalf.
That was me. Yeah, exactly. I did kind of promise that for you, but it's still binding at the end of the day.
So what am I working on lately? I am working on some. I don't know how much to disclose. Working on some ideas I had for different ways of estimating realized volatility to get some of the noise out. Using some, it's not all brand new. It's kind of improving on what some others have done in the literature, but some of it is, I think, fairly new. And so I'm working on that, testing and making sure it's quality before putting it out into the public. But that's kind of a longer-term, bigger research thing I've been working on, as well as quite a lot of daily and weekly ideas going out to clients these days. So as always, if you're interested in some novel ideas for trades and risk management and the occasional economic diatribe as well, feel free to get in touch.
All right. Thank you for that, Jared and Mark. And of course, on behalf of Jared and Mark, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing. And of course, I don't want to forget about our friends over there at Russell. If you haven't checked out what they have cooking over there on the index and on the options and indeed on the volatility side, then surf on over to russell.com/US. You can check it out for yourself. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.